Hello, folks. Welcome to the Power of Zero show. I am your host, David McKnight, best-selling author of The Power of Zero, Look Before You LERP, The Volatility Shield, and Tax-Free Income for Life, all of which can be purchased in single copies on Amazon or wherever you find books. And they can be bought in bulk at davidmcknightbooks.com. You can actually combine books and get bulk discounts as you combine your purchases. If you are looking for someone to help you navigate all of the pitfalls that stand between you and the 0% tax bracket, why not head over to davidmcknight.com? We can connect you with a member of our elite Power of Zero advisor group, all of whom have been trained, vetted, qualified personally by me. If you are an advisor who wants to transition your practice to a Power of Zero style practice, head over to powerofzero.com and we can set up a phone call. All right, today we are going to talk about the recently released Joe Biden capital gains tax proposal. Before we do that, however, I want to address a couple of things. I got several emails over the course of the last several weeks as I've taken on some of these new proposals coming out of the Joe Biden White House. People suggesting that I'm taking an increasingly political approach or that my political colors are shining through. And I have to remind everybody that this is an apolitical program. My job is just to call out fiscal irresponsibility whatever side the aisle is on. In fact, I would point you, for those of you who think that I did not criticize Trump at all during his administration, I would point you to an episode that I did a couple of months back called The Postmortem on Trump's First Term, in which I roundly criticize. It's actually based on an article by Maya McGinnis, Committee for a Responsible Federal Budget, or I roundly criticize most of what came out of the Trump White House. So if what I say today and in subsequent podcasts about proposals that come out of the Biden administration or even future Republican administrations, they need to be perceived as not political views, but mathematical views. So I tend to call out fiscal irresponsibility wherever I see it. And there may be a little bit of that today, but I certainly don't think that Republicans over the last 20 years have been innocent of fiscal malfeasance or fiscal irresponsibility. So that said, let's jump into today's show. Let's talk about the proposal that recently came out. And when I say recently, we're talking about 4 days ago. Joe Biden came out with a proposal to reform capital gains taxes and the increased revenue that is thought would come from this proposal, this legislation, would produce about $1 trillion to pay for childcare, universal pre-kindergarten education, paid leave for workers, so on and so forth. They're calling it the American Families Plan. Before we talk about what the proposal is, let's talk about what is the state of capital gains tax rates currently. We know that if you are in either the 10 or 12% tax bracket, you don't pay any capital gains tax at all. But capital gains tax is 20%. And if you make more than $250,000, including from investment income, you pay an additional what they call surtax. It's the Obamacare surtax. It was the surtax that was brought about to help pay for Obamacare. And what that says is that any dollar above and beyond $250,000 of investment, well, so you have your basic earned income, and then any investment income that gets piled on top of that, including any income that takes you beyond that $250,000 threshold. So you would pay a 3.8% surtax on that. So really, for the wealthy Americans that this new proposal is targeting, we're starting at a baseline of essentially 23.8%. That's the status quo. And so what we'll be doing today is we'll be talking about what the proposed legislation is and how high that number could go, and if that's something that you need to worry about. So generally speaking, when it comes to capital gains tax, there's potentially 4 different taxes that could come in play. The first one is basically the federal capital gains tax. The second one is a state capital gains tax. The third one is in some parts of the country, you actually will pay a local capital gains tax. So for example, if you live in New York City, your capital gains tax, in addition to the state capital gains tax, would be 3.876. And then on top of all that, you could also have that Obamacare surtax, which is 3.8%. So let's talk about what the proposal is. The proposal is that anyone that makes more than $1 million per year would see their capital gains tax go from 20% up to 39.6%. Okay, so that's a doubling right there. You would still have the state capital gains tax. You would still have the local capital gains tax in some parts of the country, and then of course you would still have the Obamacare surtax, which is the 3.8%. So what would that look like in various parts of the country? Okay, so New York City, if you included the local 3.876, you would see an all-in at 58.2%. Residents of Portland, Oregon would face a top capital gains rate of 57.3%. Not a lot is changing here except for the federal rate. So if you strip away all those other taxes, basically what you're looking at is an increase of the base capital gains tax rate for wealthy individuals from 20 to 39%. So essentially a doubling. We're talking about a doubling in the capital gains tax rate. That would produce essentially $1 trillion. And this, of course, comes in the wake of the $2.3 trillion jobs and infrastructure proposal that has run into stiff headwinds from Republicans. So the question becomes, is this likely to pass? And if it's not likely to pass, what are we likely to end up with? By the way, how could this pass? It's almost certainly not going to pass by the usual route of, getting a filibuster-proof 60 votes in the Senate. It's, as you know, it's evenly split. It's 50-50. So any sort of adoption of a plan would have to come under budget reconciliation. And under budget reconciliation, all you need is a simple majority. So they would take the 50 senators, 50 Democratic senators, plus Kamala Harris, which is the one vote that would push them over the top. So it would all happen through budget reconciliation. What my sources tell me is that this proposal is not likely to go through in its current form because there are some Democrats in the Senate who simply think that this tax is going to be too high. In fact, Steve, what's his name? Steve Chiavarone, nice Italian name there, said that this could be viewed as just an aggressive negotiating tactic. In other words, you're going to get the biggest, most aggressive tax plan right out of the chute, something that they know that they would not likely get approved, and you would sort of return to some sort of middle ground. And let's see, Thomas Hayes out of Great Hill Capital LLC, which is a hedge fund, says that if this bill had a chance of passing, the Dow Jones would already be down 2,000 points. In other words, I think what most people are seeing this bill as is just this initial volley, right? It's initial salvo, if you will, knowing that if you start high and you enter the negotiation process, it'll come down to exactly what you are looking for and exactly what you intended to get from the outset. So what are people on both sides of the aisle thinking that this is going to end up at? By the way, let's take a look before we talk about that. Let's talk about where this 43% capital gains rate would put America relative to its peers around the world, it would essentially be the top capital gains tax rate in the world. Average capital gains tax rates in Europe are only about 19.3%. And the high rate there is Denmark, which collects 42%. Finland charges 34%. So when you add up all of the different capital gains tax rates, this could far exceed anything else we've seen in any other part of the world. Okay, so what are we likely to see? Here's an interesting quote, still from Steve Chiavarone. He says, you should expect that you will get at least initially the biggest, baddest, most progressive policy proposals with the understanding that they won't get everything they want, but define the scope of the negotiation. Maybe Biden doesn't get 39%, he will get 29%. I've also seen other suggestions that what will likely go through is 28%, which I think is what, if memory serves, is what we had during the Clinton years. So yes, what we're seeing here is the potential for, in fact, what we saw when the proposal was first released was some initial tremors in Wall Street as they sort of reckoned with what the implications of this proposal will be, but the stock market came right back up. I think as people recognize that this legislation would not likely go through in its current form. Okay, so even if capital gains tax rates do go up, will this affect you? Yes, it'll affect you if you make more than $1 million per year. If you do not make more than $1 million per year, it's not going to affect you at all. If you are concerned about capital gains tax rates, I've got some advice for you. Quit accumulating huge amounts of money in your taxable bucket, right? Quit accumulating huge amounts of money in an account where the IRS requires you to pay a tax each and every year. I mean, even if you have long-term capital gains, you're likely to pay taxes on dividends along the way. And long-term capital gains, as we are seeing now, proposals are that they are going to go up. I don't think to solve our nation's problems, raising capital gains rates just on people that make $1 million is going to do it. I think we're going to need to see broad-based, a broadening of the tax base, broad-based increases in tax rates across the board. Not that I would love that. I just think that you're going to have to see an increase of taxes, a reduction in spending, some combination of the two, in order to solve the fiscal condition, the fiscal challenges that are facing our country. So how do you prepare yourself against the inevitability of higher capital gains tax rates? Like I said, don't accumulate a lot of money in your taxable bucket. There are better places to own investments. We want to be taking advantage of all of the tax havens, as it were, that the U.S. government provides for us. When I talk to clients, I generally find that they're not taking advantage of any of the available tax havens that are currently afforded us within the U.S. tax code. So, for example, you have the Roth IRA, you have the Roth 401k. The Roth 401k has massive contribution limits. If you're over age 50, you're looking at $26,000 for you, $26,000 for your spouse. That's on top of the $7,000 you can put into your Roth IRA for you and $7,000 for your spouse. That's a lot of money that could be put into tax-free vehicles. There's unlimited amounts of money that can go into Roth conversions. You can convert, if you had $1 billion sitting in your IRA, you could convert all $1 billion of it to your Roth IRA all in 1 year. In fact, that's probably how I would recommend it. If you really had $1 billion in your Roth IRA or in your IRA, you'd probably want to convert it all in 1 year, because RMDs alone will put you in the highest marginal tax bracket anyway. So those are the 3 Roth style accounts. You'd want to have some money in your IRA so that when you take money out, it gets offset by your standard deduction. Of course, we have the LIRP. The LIRP is the great antidote to taxation in the taxable bucket. You don't have to like life insurance. You don't have to like life insurance companies. You just have to like them a little bit more than you like the IRS, because in the end, someone's getting your money. You just as soon get something useful in exchange for that, what you're paying. And at least in the case of the LIRP, you're getting safe and productive growth. You're getting a floor where you're never going to lose money. Okay, you're getting tax-free growth, and you're getting a death benefit that doubles as long-term care. So you're getting something useful in exchange for what you're paying for that bucket. So the LIRP becomes the receptacle for all of the money that would otherwise have been destined for your taxable bucket. Why is the LIRP such a suitable alternative? Well, number one, there's no income limitation. So for if you do in fact make $1 million or more per year, you could situate dollars within the LIRP and be sort of impervious to these capital gains tax rates. So there's no income limitations. There's no contribution limit. So if you have $1 million in your taxable bucket, you can step that money over to the LIRP in piecemeal fashion and get all those dollars repositioned into an environment where it's going to grow safely, productively in a tax-free environment, and you don't have any contribution limits. So whether you make $1 million or not, I think that there are lots of different alternatives where you can situate assets to grow tax-free wealth without having to worry about what is likely coming down the pike as it relates to all of these different tax increases that we're seeing. A reminder that we're seeing tax increases on income tax for anybody that makes more than $400,000. You'll likely see, as we discussed today, an increase in capital gains tax rates on anybody that makes more than $1 million a year. And so this is what we're looking at. I don't think, one other observation is I don't think that any of these tax increases that we've discussed today and in past episodes really strike at the heart of what's ailing our country's fiscal situation. Because whenever these taxes get raised, the money is always earmarked for some new initiative. It's never aimed at fundamentally restructuring the entitlement programs that are driving the fiscal problems in our country, that's driving the debt higher. It's Social Security, Medicare, Medicaid. We consistently borrow money to fund those programs. And we also print money to pay for all of the other initiatives that we want, but that we can't afford to pay. So that's really the podcast today, folks. I just wanted to make you aware of what's coming out of the Biden administration as far. Of course, we will keep you posted once an official proposal hits Congress and what gets voted on, and if it's by budget reconciliation or some other way, and ultimately when we think that will go into effect. I do believe that what we'll see is a 28 or 29% capital gains tax rate on those who make more than $1 million per year. Once again, if you're looking for help navigating all of these different issues, we're happy to help. We're happy to introduce you to someone in our network of advisors, the Elite POZ Advisor Group. They're trained, vetted, qualified personally by me. We can connect you with one in your neck of the woods. And if you're an advisor and want to learn how to incorporate these strategies into your financial practice, head over to powerzero.com. Of course, I would always love a follow on Twitter. It's at McKnight & Co, at McKnight & Co, and would love a review of any of our books. And if you want to watch our movie and you're a financial advisor, head over to McKnight, it's The Tax Train, thetaxtrain.com. Thanks everybody for being with me on the show today, and we'll look forward to chatting with you same time next week.